and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Marcus Brooks, Head of Multi-Manager for Schroders. Hello, Marcus.
Hi.
So a bit of bad news today. I have been hearing from many multi-managers, multi-asset managers like yourself, that actually the good times are over. The significant rallies that we've seen across numerous asset classes over the last 5 years are no more, and we should be moving into gold and cash and sort of hunkering down. What's your position on that?
May seem a bit dull, but I have to say I agree with a large part of that. I mean, if you just look at the S&P 500, the US stock market started rallying March 2009, all the way through today. It's done really, really well. It's up over 300%. And it's the second longest bull market in history. Now, you could say, well, so what? Why can't it be the longest? Why can't it do even more from here? But we're now at a stage where the economic tailwinds that economy has had are starting to fade slightly. Now, it doesn't mean that we go into recession straight away, but it does mean that all the really, really good stuff that help corporates make excessive profits, they're starting to wane. And as a result, you've got what appears to be a relatively expensive market at peak profitability where everyone's fully invested. It's really hard to see how it makes progress from here.
It's quite difficult to call, though, market timing, isn't it? Because I know that a number of managers, very successful long-term managers, made the call too early around 2010, 2011, and actually missed out on a rally. So I can understand how investors might be quite nervous about doing that again.
Yeah. Well, I think actually when we look back in history, the 09 through to 11 was actually probably a full market cycle in its own right, because the rebound at that stage was led by value sectors that we would describe today, mining, energy companies, and to a degree the victims of the great financial crisis, the financials, the banks in particular. And then from 11 onwards, it's been a totally different profile. So all the emerging market type names, the energy companies and the mining, they've had a dreadful, dreadful time since 11. So I would almost define it as two different market moves. The first one, the recovery. The second one, the maturation of the market cycle, which this time has not been led by really cyclical value things. It's been led by super safe stuff. And this is really bizarre. It's not like we're saying, oh, well, the economy is doing fantastically well. Consumers are making more money. They're spending more money, they're going buying new cars. Those are not the sort of companies that are benefiting from those sort of trends. The sort of companies that are doing well are pharmaceuticals, utilities,
defensive stocks.
So I think when you can characterize the last 7 years, two stages, the second stage has really been a bull market in safety. Because I don't think we ever really got over the great financial crisis. I don't think the enormous levels of debt that led to it ever really got taken away. And therefore, the sort of slight recoveries where we all hoped that this was a return to trend economic growth, that then disappointed. And then we all thought, oh my gosh, it's going to be another great financial crisis. And through that phase, I think investors thought, well, if I've got to be invested in anything, I want to be invested in safe stuff. And if you get enough people doing the same thing, those are the assets that do really well.
Now, the problem is those assets have now become extremely expensive. So how do you manage both that cautious stance with diversification?
Well, this is where it all gets really tough now. So if you were to suggest that we're towards the end, we're late cycle, we're towards the end of an economic cycle, that we may be somewhere near, therefore, the end of a market cycle, the sort of portfolio you would traditionally have would be to start going by those dull, sensible utilities, tobaccos, pharmaceuticals. But as you say, that is now a very expensive part of the market. So we've got a quandary, as all investors, that the safe stuff is actually pretty expensive. Now, the risky stuff, historically, mining, energy, financials, the stuff that you would absolutely avoid at this point, looks outstandingly cheap. To the degree you could base a case, and I wouldn't necessarily want to be too firm about this, but you could base a case that because they're under-owned, because they're so cheap, even if the bad stuff does happen, they could be okay this time. They may not necessarily make you money, but they could outperform the safe stuff. Now, that could be a very weird outcome for a lot of investors. I don't think they're positioned for that at all.
Marcus, thank you very much.
Thank you very much.
This is Emma Wall from Morningstar. Thank you for watching.